What is going on, you guys, and welcome back to another video. Before we dive into today's video, I am very excited to announce 3 days ago, we brought home our baby girl, and it has been chaotic. It has been crazy. It's just been the darn coolest thing ever. If you're not already following us over on Instagram, go do that now. We got so much love and support from you guys over there, and thank you in advance to all of the comments and kind words. Just the past few days, it has been like truly chaotic and fun. Everybody's healthy, baby's healthy. Everyone's just recovering and trying to get into the swing of things. So probably not gonna be posting as many videos for the next week or two, or we'll see how long it takes, but I promise I'm gonna try to do this, just trying to balance everything over the next little while. But yeah, today's video, I wanted to talk about why I personally choose not to pay down my mortgage any faster than I really have to. And I'll start by saying that just because this works for me absolutely does not mean it's the be all end all and that you should be doing this. I actually think for a lot of other people, doing the exact opposite makes a ton more sense. It is without a doubt a very personalized situation when you're either factoring in the math, so the mathematical, the dollars and cents calculations and side of things, which we're gonna run through some numbers in just a moment. But bigger than that, I think it really comes down to the psychological side, the emotional aspect of how you feel of carrying bigger debt loads or lower debt loads. I think that's honestly a major factor. But today I want to share with you guys pretty much what I do. If you are new to the channel, my name is Brandon. As always, we do have our Investing Academy as that first link down below if you are looking for courses and training in the stock market. But just for some context to kind of set the stage, I do currently invest in the stock market as well as invest in real estate. I have two mortgages out right now. Both of these are what we'd consider a traditional mortgage, where every 2 weeks or bi-weekly is how I have it set up, that we just pay these mortgage payments. And whether we're talking about putting money towards real estate or paying down that debt or putting money into the stock market, both of these goals are getting me to my long-term objectives of being financially free, one day being able to retire, building up my net worth and my assets. But the question that I ask myself and what I want to cover in this video is, with the extra cash that I have available today, which makes more sense? From a top-down level, this is just one of the easy ways that I can kind of break this down. Doesn't have to be split up this way, but if I kind of have my income here at the very top, there's various pools or various kind of categories I could sort that in. For the case of this example, we're obviously going to have our spending money. These are things that I would call the necessities of life. So putting food on the table, pets, for example, getting pet food, just the daily cost of living. Beyond that, if I'm looking where to allocate money outside of that, we can absolutely pay down the mortgage in terms of the mortgage payments. There's obviously strata fees and home insurance, those types of things. And then we have just investments in the stock market. So popping contributions in month after month to my RSP, my TFSA, our corporate accounts or our margin or cash accounts, et cetera, et cetera. Technically, I do have the option of reinvesting in my business, which is more or less unique to myself. Nevertheless, the point of this video today is saying, if I have this extra money, so we've got money beyond the daily cost of living, where should I allocate it? Let's talk about that. And I want to go over just a few baseline math assumptions so that our calculations will make sense. Mortgage number one sits at a rate of about 1.35%. This is obviously a variable rate term. Mortgage number two sits at 1.45. So again, prime minus one, again, a variable rate term. Let's just go with the higher amount on that for this projection. So we'll be running with 1.45. I'm going to assume that a benchmark rate that we can say is fair, an accurate thing that we can maybe project out in terms of what we would receive with our stock market investments. Let's just run with 7 to 8%. I know a lot of people like to run their math with a 10% rate of return. I think that's a little bit bogus when you factor in inflation. When you look back at the history of the stock market, I think 7 to 8% is a very fair range. To be conservative even, however, what I would do for these calculations is even set it a bar below. So let's just say 6%, which I think is a very fair rate of return given the investment styles and strategies that I go for. Business return, in terms of if I reinvest money in my business, go spend money on ads or hire out, what return can I get on that? That is very, very hard to quantify. Very hard to quantify, but I'll tell you it's the highest return out of all of these on the list today. But we're just gonna leave it at that. And I wanna run through a quick calculation that I ran through in the past, and I've just revisited it here. This is a calculator from TD. It's free to use. You can go search it up, Google it up if you'd like. It's a mortgage calculator, and I basically put in two scenarios. On the left, we have an example mortgage amount of, let's say, $500,000. Very typical mortgage. The rate here is 1.55%, so close enough to what we are running with the 1.45. What I want you to do is look down at the interest paid row. And in scenario number one, this is just going to be our typical mortgage paid bi-weekly. During this 5-year term, we see that we pay $35,286 in interest, a big chunk of money going to the banks. And of course, this is just over a 5-year term, not the entirety of the mortgage. Nevertheless, a big chunk of money there. Now on the right, we have the exact same parameters. This is our scenario number 2. This scenario takes $1,000 every month and puts it towards reducing this debt. It puts it towards our mortgage. What we notice, what's key here that I want to highlight, is absolutely the interest that we save on does get notched down. And the math, just FYI, is about $2,500 saved, given this example, over the 5-year period. Now, of course, you're also building up more equity. Nevertheless, the objective of today is I'm wondering, will I be making more money by investing this money in the stock market or saving more money by paying down my mortgage? Let's just run with the ballpark of $2,500 over this period. Now, for the case of this example, it may not be entirely realistic, but it is actually more applicable to me. For those that have been following the channel, you guys know that I basically emptied out my TFSA in the latter part of last year. I've got a ton of tax-free room that at my point, looking forward, I'm going to be looking to put money back into this account and grow this account. So for this example, I actually ran with a tax-free account. Again, this wouldn't be the case. We're gonna talk about a bunch of variables in just a moment. But if I took that $1,000 and I invested that every month for 5 years, let's just go even more conservative at a 5% rate of return. And this is of course compounded annually because of the stock market. 5% annual rate of return. That brings us to a total of $68,090, which is growth of about $8,000. So no question about it, even with using a conservative rate of return, which again is below what I would actually project out for myself, we do absolutely come out on top by allocating our money to the stock market. If we were able to achieve a 5% rate of return, at the end of the day, after this 5-year period, I could take some of those profits and go choose to pay down my mortgage if I choose so. Nevertheless, the dollars and cents make sense this way. I actually found that an easier way to look at it is a calculator, which I will link down below. It's from the OSC, or Get Smart About Money, pay down debt or invest. Pretty much the exact question that we're trying to ask. This is just a different way of looking at it. And here we have our loan. I put here 1.45%, so actually a little more accurate. A marginal tax rate of, let's say, 35% for myself. Again, our investments are going to be at a 0% tax rate, assuming that I'm investing in a registered account. But if we take a look at this scenario, given a mortgage rate of 1.45%, which again is very applicable to my case, at the bottom here, we have a break-even rate, essentially what we need to earn in order to break even for it to be a wash. Anything beyond that would be gains in our favor. So a very, very low benchmark to hit here. Again, we're talking very low interest rates, very pleased with my 1.45% rate. Again, things very much may be subject to change. Exactly why I have scenario 2 in this case, which says, who knows what is in store for us a number of years down the road. Let's run this exact same projection. And rates do increase. What if my mortgage rate down the road sits at 4.5%? Again, a variable rate term or a variable rate mortgage. Well, in this case, the break-even return that I'd have to make in the stock market sits closer to 7%, which is right in line with my projections, but right on that bubble about where I'd start to feel a little bit, you'd have to weigh the decision a little bit deeper. Scenario number 3, let's just look at a 7% mortgage rate, which I know sounds crazy right now, and it's something that probably we can't even imagine. I'm not anticipating this, but just looking at kind of our extremes, it's not impossible that we won't get to this if rates do tick up. They have been here in the past. With a 7% mortgage rate, we need to have a break-even return in the stock market of just shy of 11%, which is probably quite a bar that I would find maybe a little bit stressful to hit. Now, basically where we stand today, we do have to factor in that we are in a place and we are in a time with very, very low mortgage rates. And I know that there's a big discussion right now of what's going to be happening over the coming year and beyond. We never, ever really know. But when I crunch the math here today from a simple dollars and cents perspective, I feel that I can earn a better return in the stock market than paying down the debt on my mortgage and reducing the interest that I pay. Now, there are absolutely a number of variables that we do have to consider here. At the end of the day, these are just projections. We're just looking out and saying, based on what we know today, what do we think makes sense? There are so many things that time will tell whether it made sense or it was the right decision or not. Some variables that I have to factor in are, of course, let's say stocks don't perform as well as I'd hoped. If I set a projection here and we underperform, or the markets just broadly underperform, well, that's obviously going to be huge. Real estate in and of itself, that appreciates or grows at its own pace. That could be faster or slower. Again, interest rates are just an absolutely huge one. If I was going to be paying down my mortgage faster, which again, I'm not, it would be quite advantageous to do that actually upfront. Just FYI, we're actually eating away at more of the interest payments. Again, I'm not in that position. At the end of the day, let's transition on into this. It doesn't personally bother me to be carrying a big debt load or a big debt burden, because I very much consider my mortgage to be a healthy debt. Not all debts are created equal in the world of finance. You have good or healthy debts. You have unhealthy debts, which should be paid down right away. If we were talking about credit card balance that I had here, or a payday loan or a cash advance, something along the lines of that, no question we want to eat that down. But whether it's a mortgage, personally for me, I even consider things like student loans. I know that's kind of a trickier one, but I mean, the rates that often you may be paying on student loans are often forgiven and they're quite low. To me, it's like, because those rates are so low in the current day, absolutely we can outpace that. It never feels good. I shouldn't say that. It feels good when you are earning money in the stock market and you literally see a return on your dollars. You see, hey, I put in $10,000, $100,000, and it went up by 10% and you have generated money. But we do have to understand that just as important, if we are decreasing debt, if we are lowering our debt burden and essentially eliminating interest that we would have been paying, it doesn't feel the same, but from the top level, from our net worth, absolutely, we are, I'd say, actually in a very similar position. Net gain, net loss, it will 100% not feel as good because you're not actually getting more dollars in your pocket today. But if you can eliminate debt that you're paying a 10%, 7% interest rate on, credit cards obviously up in the 20% range, well, you're actually winning at the end of the day. Now, this is of course just factoring in the mathematical side. Just as big of a component to this is whether you are the type of person that wants to be debt free and you don't like the idea of having a big mortgage out on your home. It's one of your major goals to say, I want to pay this off as quickly as possible. Maybe to you, that's something that is a very big priority for your stress levels and it helps you sleep better at night. Well, in that case, absolutely. For me personally, it's not as big of a deal. And again, I'm just sharing with you guys what I personally do. But if that was the case that you were in and you just said, hey, I don't want to, have all this debt outstanding, well, absolutely, scrap the numbers, scrap the dollars and cents. It makes sense to do that because at the end of the day, you should be kind of happy with what you're doing. One other factor that I think I very much consider, and it's not very widely talked about, when I take a look at my net worth, right? If I looked at like top down stuff, where my assets are held, where my money is held. If I were to fast forward a number of years down the road and I have chosen to very aggressively put money towards my home, build equity in the home, and kind of put the stock market on the side, when I do fast forward, that portion of my pie, my allocation of my assets personally, are going to be very heavily swayed in real estate. Personally, for me, I don't want that to be the case. Not that real estate is a bad investment. It's such an awesome investment, but I also want my stock allocations, that portion, to be just as big, if not bigger. And that's because I really love the stock market. I thoroughly enjoy this. Like I love investing in stocks. Not to mention, of course, that yes, of course, you can draw money from your home. There's always ways to tap into your home equity, lines of credit, whatnot. But the stock market just tends to be so much more liquid, so much more accessible. For me, it's like I'm going to be building equity in my home, having that paid down automatically. But I kind of want to allocate my money elsewhere because I believe I will be getting a better return. And from a top-down, asset allocation level or from a net worth perspective, it's going to even out my assets at the end of the day. Now, I absolutely want to hear from you guys what your opinions on this. And if you feel comfortable sharing, again, I'm literally just sharing with you guys my personal ideas and my personal experience. For me, do not hesitate to leave a comment down below if you are the type of person that decides to pay down your mortgage faster or you choose to invest. Maybe a little mix of both. I know there are so many people from looking up online and looking in the forums that put such a priority on moving that debt, paying that debt down. Not wrong. There is no right or wrong. Yes, dollar and cent may suggest something, but at the end of the day, this is personal finance 101. It's personal for a reason because it's personal for you. It's whatever works best for your situation. And I would love to hear from you guys down in the comment section below what you do. But I think with that, I will wrap up today's video. If you guys did enjoy, please take a moment and drop a big thumbs up. That helps out so much if you appreciate the content. If you're not already subscribed to the channel, take a moment and subscribe. Also, take a moment and hit the bell for notifications. That way you are notified when I do make a post. And of course, we do have our academy down below if you are looking for course and training in stock market. I will just kind of sign off here with just some ending thoughts, and thank you in advance for all of the kind comments and best wishes. You guys are honestly the best. Again, if you're not already following me on Instagram, so much love and support that's been shown over there, and we are just so excited for this next chapter of our life. Baby's healthy, wife is healthy, trying to get as much sleep as we can. Now, having gone through the experience over the past few days and witnessing what it takes to bring a baby into this world and being there firsthand, there's just this newfound appreciation and respect for anybody out there who's either gone through that or will go through that. I mean, everybody who's living has gone through that at some point. My wife has just been an absolute all-star, like from the beginning of pregnancy all the way through to now, because stuff doesn't end now. You know, there's still a lot more that we're, going through, and it's just so cool to be there. And I'm obviously trying to do the best that I can to support her where I can. When you're kind of sitting there, like as a male, you kind of feel in a sense helpless. Like you're not the one going through it. You're just sitting there and obviously supporting where you can and doing what you can. But it's just like, man, they do so much, and they will continue to do so much, and it's just such a cool experience, right? The miracle of life. I love it, and our baby is just so funny and crazy. We're gonna share so much more over on the Instagram page if you haven't already followed us there. But I'm so blessed that you guys have supported me along the way. If I need to take a few days off from filming videos to help support the family and get into a rhythm and routine, which there is absolutely none of right now, and try to get some sleep, thank you guys for being patient with me. We still got Mark. Mark's still going to be posting videos. That's why I brought him on, right? But no, we're still going to be pumping out content for you guys. And again, I'm just trying to find that perfect work-life balance. Absolutely, I will be back stronger than ever. At least I think so. We will see. I promise you guys I will try my best, but I will probably take a little bit of time off here just for the next little while, just because I want to make sure everything's running smoothly and make sure everything continues kind of going the way that it has been going, because so far so good. But with that said, probably gonna go home, catch some sleep, because sleeps have been very bad, very, very bad over the past little while. Very little sleep. The baby's up every 2 to 3 hours, and yeah, it's fun. It's fun at the end of the day. I was so excited for this. Baby did come a couple weeks earlier than expected, like full term. So she was full term, but she just came into it, and yeah, it was just so darn cool. Thank you guys all for watching the video. If you enjoyed, again, drop a big thumbs up. Thank you all for the support. Make sure you're subscribed. Investing Academy down below. But as always, I thank you guys for watching. Hope you enjoyed, and I'll see you in the next video.